The markets are shifting faster than ever, and if you aren't paying attention, you are going to be left behind, permanently. Look closely at your screens. Look at the panic bleeding into the financial districts, because today is Tuesday, May 5th, 2026, and the global financial architecture as we have known it for the last 50 years has just suffered a catastrophic, unrecoverable fracture. Hello everyone, I'm John A.G., and welcome back to Master Macro. If you want to stay ahead of the next economic wave, hit that subscribe button right now. Make sure you watch this video until the very end, because the data I reveal in the final minutes changes absolutely everything about how you will need to protect your family and your future. We are standing at the epicenter of a monetary earthquake, one that history will record not as a sudden, unpredictable accident, but as the mathematically inevitable conclusion to decades of staggering policy hubris. What we are witnessing on this very specific Tuesday in May is the absolute, undeniable unraveling of the Fiat illusion. The Federal Reserve, trapped in a labyrinth of its own reckless design, has finally executed the desperate maneuver the smart money has been anticipating for a generation. By signaling an unprecedented capitulation to systemic debt pressures this morning, they have effectively lit a match on the last remaining shreds of the United States dollar's purchasing power. This is no longer a theoretical academic debate about transitory inflation whispered in university halls. It is a violent, real-time repricing of global wealth that has just sent physical silver hurtling past the historic, psychological barrier of $100 an ounce. To comprehend the sheer, devastating magnitude of this 2026 crisis, we must forcibly strip away the sanitized noise, the carefully crafted press releases, and the outright deception broadcast by mainstream financial media. We have to examine the raw, unforgiving mechanics of the global money system. For decades, this system has been sustained by a fragile, highly leveraged framework of blind confidence, exponential debt creation, and the unquestioned supremacy of the dollar. The Federal Reserve has been fighting a multi-front war it was mathematically destined to lose since the dawn of quantitative easing. On one side, the suffocating, astronomical weight of sovereign debt demanded perpetual liquidity and artificially suppressed interest rates just to keep the government functioning. On the other side, the brutal reality of structural, deeply entrenched inflation threatened to completely hollow out the domestic economy. The actions taken today confirm definitively that the central bank has chosen its poison. They have made the cold, calculated decision to sacrifice the currency in order to save the sovereign bond market. This covert bailout, engineered through massive, opaque liquidity facilities, has sent an unmistakable, terrifying shockwave through the global financial plumbing. The pre-market indicators had been flashing deep, systemic red for months, telegraphing severe underlying distress and a massive liquidity drain. Yet these glaring warnings were largely dismissed, mocked, or ignored by a public that had been systematically conditioned to believe in the omnipotence of central planners. Now, the velocity of this currency collapse is wiping out entire retail portfolios overnight, exposing the fatal, devastating flaw of holding paper wealth in an era that violently demands hard asset supremacy. You have to understand that the explosive rally of silver to $100 is not merely some speculative anomaly driven by day traders or algorithmic algorithms. It is a profound, screaming symptom of a dying currency regime and the sudden, violent awakening of the broader market to physical reality. For generations, the pricing of precious metals has been heavily managed, suppressed, and manipulated through a convoluted, opaque system of paper derivatives. Financial institutions essentially created an artificial, unlimited surplus of paper-silver contracts that completely masked a severe, growing physical deficit in the real world. They traded shadows and called it substance. But paper contracts cannot conduct electricity. Paper derivatives cannot build next-generation solar arrays. They cannot be placed inside the millions of electric vehicles rolling off assembly lines. And they most certainly cannot protect your hard-earned wealth from the ravages of a hyperinflationary monetary policy. Silver possesses a formidable, entirely unique dual mandate that makes it the most critical asset on the planet right now. It is an irreplaceable, highly conductive industrial component that is the absolute bedrock of the entire green energy transition and the explosive growth of artificial intelligence data centers, while simultaneously serving as a 5,000-year historical anchor of monetary truth. As the Federal Reserve moves to monetize debt on a scale previously thought impossible, institutional capital, the sovereign wealth funds, the billionaires, the family offices, is scrambling for the exits. They are violently breaking the paper manipulation scheme by standing for physical delivery, desperately seeking refuge in the exact finite metals that central bank economists have spent decades arrogantly dismissing. The physical supply of silver is effectively vanishing from global vaults, and the price discovery mechanism, broken for so long, is finally correcting decades of fraudulent suppression in one violent, unstoppable upward surge. The true, heartbreaking tragedy unfolding right now, on this 5th day of May, is that retail investors, the working foundation, the backbone, and the middle class of the global economy, are the ones left entirely exposed to the blast radius of this financial detonation. They have been lulled into a false, comforting sense of security. They have been trained, almost like Pavlovian dogs, by decades of financial engineering to blindly buy the dip, to trust the system, and to place their life savings into vehicles designed to slowly bleed them dry through the silent, regressive tax of stealth inflation. Traditional asset allocations, the vaunted, universally recommended 60-40 portfolios of stocks and bonds, are collapsing in real purchasing power terms. You might log into your brokerage account and see nominal gains. You might see the numbers go up. But because the denominator, the dollar itself, is losing its fundamental value at a staggering rate, you are actually growing poorer by the minute. The wealth of the middle class hasn't simply evaporated into the ether, it is being systematically harvested. It is being forcibly transferred from the uninformed to the hyper-prepared, from the holders of infinite paper to the owners of finite physical assets, and from the realm of fiat illusion to the bedrock of tangible reality. The everyday market participant is standing by, paralyzed, watching their purchasing power be incinerated. They are caught perfectly on the wrong side of the greatest and most ruthless wealth transfer in modern economic history, simply because they trusted an economic model that was mathematically designed to eventually fail them. We must look back at the mechanics of how a nation destroys its own currency to understand what happens next. It always begins slowly, an insidious creep of deficit spending that politicians justify as necessary for national security or social stability. But debt compounds, and eventually, the cost of servicing that debt eclipses the productive output of the nation itself. We crossed that Rubicon years ago. What we are experiencing now is the exponential phase of currency debasement. When a central bank is forced to print money just to pay the interest on the money it already printed, you have entered the terminal stage of a fiat life cycle. The market sees this. The global south sees this. The BRICS nations have been aggressively hoarding physical gold and silver for the last decade, preparing exactly for this day, preparing to insulate their economies from the blast wave of a collapsing Western debt supercycle. They are moving with terrifying speed to settle global trade, energy contracts, and commodity exchanges entirely outside of the dollar network. This is accelerating the absolute decline of Western fiat dominance. The dollar is losing its petrodollar status, its reserve status, and its unquestioned authority, all at the exact same time. And as the world rejects the dollar, those trillions of paper notes are flooding back to our shores, chasing a finite amount of domestic goods, services, and hard assets, creating a vicious, self-sustaining feedback loop of hyperinflationary pressure. Think deeply about the psychology of the retail investor right now. They are conditioned to believe that a stock market at all-time highs is a signal of economic health. But in Weimar Germany, in Zimbabwe, in Venezuela, the stock markets also hit all-time nominal highs, right as the underlying currencies collapsed into worthlessness. A rising stock market in 2026 is not a sign of prosperity. It is a massive, flashing warning siren of currency flight. People are buying equities not because they believe in the long-term fundamentals or the earnings multiples of these corporations, but because they are terrified of holding cash. They are treating the stock market as a desperately flawed inflation hedge, completely unaware that when the true liquidity crisis hits, equities will be liquidated indiscriminately to cover margin calls in the bond market. The only true safe harbors, the only assets without counterparty risk, are the tangible commodities that take human labor, massive energy, and heavy machinery to extract from the earth. The fact that silver sat below its 1980 all-time highs for nearly half a century, while the M2 money supply expanded by thousands of percent, was the greatest pricing anomaly in the history of capital markets. And today, that coiled spring has snapped. The suppression has failed. The physical market has fundamentally broken the paper market, and the price of silver at $100 is merely the first major milestone in a fundamental repricing of all tangible goods against a dying fiat system. We have to scrutinize the industrial side of this equation to fully grasp why silver specifically is the linchpin of this entire financial paradigm shift. We are in the midst of an unprecedented technological revolution. The build-out of artificial intelligence requires an incomprehensible expansion of energy infrastructure. We are talking about thousands of new data centers, all requiring massive power grids, advanced cooling systems, and millions of miles of highly conductive wiring. Silver is the most conductive element on the periodic table. There is no substitute. Simultaneously, global mandates for renewable energy have forced the mass production of photovoltaic cells. Modern N-type TOPCon solar panels require significantly more silver paste than previous iterations. The automotive industry is pivoting to electric vehicles, which utilize 3 times the amount of silver as internal combustion engines, scattered across thousands of electrical contacts, sensors, and battery management systems. The military-industrial complex relies on silver for missile guidance systems, radar, and advanced avionics. The industrial demand for this metal is utterly inelastic. These manufacturers cannot simply stop buying silver because the price goes up. They must acquire it at any cost to keep their production lines moving. But the mining sector has been starved of capital for over a decade. Discoveries of new, high-grade silver deposits have plummeted. Existing mines are experiencing declining ore grades, meaning they have to move exponentially more dirt to extract the exact same amount of metal, all while their own input costs, diesel fuel, labor, steel, are skyrocketing due to the very inflation the central banks created. We are staring down the barrel of a multi-year structural supply deficit that cannot be fixed by printing more money. You cannot quantitative ease a silver mine into existence. It takes a decade from discovery to production. The collision of infinite paper money printing with structurally finite physical commodities is what is driving this historic wealth transfer. You need to recognize that the financial elite have known this day was coming. If you look at the movements of capital over the last 24 months, you see a distinct, quiet rotation out of long-duration treasury bonds and into hard assets, commodities, and infrastructure. The banks themselves, the very institutions that manage the paper derivative markets, have been accumulating massive physical stockpiles of precious metals. They tell the retail public to buy government bonds and tech stocks, while they quietly back up the truck for physical gold and silver. It is a classic misdirection play, designed to keep the masses docile and invested in the very system that is being engineered to fail them. The sudden spike to $100 silver is the moment the curtain is pulled back. It is the moment the illusion shatters. For the retail investor who has their entire net worth tied up in fiat-denominated assets, in pension funds heavily weighted in government debt, and in savings accounts yielding less than the true rate of inflation, the awakening is going to be incredibly brutal. They will find that the promises made to them by their governments and financial advisors are mathematically impossible to keep. The purchasing power they thought they had secured for their retirement will be swept away in a tidal wave of currency debasement. As we dissect the events of May 5, 2026, it becomes crystal clear that we are not just analyzing a market cycle. We are documenting the end of an empire's monetary dominance. The decisions made in the Eccles building, the frantic emergency meetings, the unprecedented liquidity injections, these are the desperate, flailing actions of a system in its terminal phase. They are trying to patch a fundamentally broken dam with paper money. But the market, the collective sum of all global human action and capital flow, has finally realized the game is over. The flight to safety is no longer a flight to the U.S. Treasury. It is a flight out of the financial system entirely. It is a return to the foundational principles of money: scarcity, durability, fungibility, and intrinsic value. Silver, alongside gold, is reclaiming its rightful historical throne at the very base of the global financial pyramid. The era of the weaponized, omnipotent dollar is drawing to a chaotic, unpredictable close, and the dawn of a resource-backed, hard money paradigm has forcefully arrived, whether the Western political class is ready for it or not. I want you to think about what this means for your everyday life. When the foundation of a currency cracks, it affects every single transaction, every supply chain, every price tag in the economy. The cost of food, of energy, of housing, of basic survival will continue to reprice violently upward to reflect the degraded value of the money used to purchase them. The standard of living for the average citizen will plummet as their wages fail to keep pace with the real rate of inflation. This is the invisible tax, the most insidious form of wealth confiscation ever devised, because it requires no legislation, no vote, and leaves the victim blaming the grocery store or the gas station rather than the central bank that actually stole their wealth. Protecting yourself in this environment requires a complete psychological paradigm shift. You have to stop thinking in terms of how many dollars you have, and start thinking in terms of how many ounces, how many acres, how many tangible units of value you control. The scoreboard has changed. The rules of the game have been violently rewritten today. You must become your own central bank. You must take absolute responsibility for your financial survival, because the institutions you were taught to trust are structurally insolvent and primarily focused on self-preservation. The window of opportunity to exit the burning building of the fiat system is closing rapidly. As the price of physical silver continues its violent ascent, as it breaks through $100 and begins its march towards its true inflation-adjusted historical value, physical availability will evaporate. We will see massive premiums over the spot price, we will see rationing by bullion dealers, and we will see widespread shortages as the panic buying accelerates. You do not want to be the person trying to buy fire insurance while your house is already engulfed in flames. You need to act with decisive, calculated urgency. The volatility we are going to witness in the coming weeks and months will be enough to shake out the weak hands, the speculators who do not understand the fundamental macroeconomic tectonic plates shifting beneath their feet. But for those who understand the history of money, for those who see the mathematical inevitability of this debt crisis, this volatility is not a threat. It is the ultimate validation of their thesis. We are watching the real-time destruction of the old financial world order right before our eyes. The purchasing power you believed you possessed yesterday is little more than a ghost today. This is not a temporary market correction. It is not a cyclical downturn that will be magically fixed by a new political administration or a different Fed chairman. It is a permanent structural repricing of economic reality. The global power dynamic is shifting from the nations that print paper to the nations that produce tangible commodities. As we navigate the brutal, unforgiving fallout of this historic crisis, the only protection left is an uncompromising, almost ruthless understanding of true intrinsic value. The time for complacency has officially passed. The era of easy money and blind faith is dead. You have to be proactive, you have to be educated, and you have to be fiercely independent in your financial decision-making. Thank you for joining me on Master Macro. I am John Agg, reminding you to stay fiercely vigilant, question every single prevailing narrative, and relentlessly protect your wealth as the storm finally breaks.